Tesla stock has been very volatile over the past few years. In this video, I will be valuing Tesla using my stock valuation spreadsheet to determine whether the company is currently a buy at the current price. If you want to use this valuation spreadsheet for yourself, then click the link in the description to download a copy. Hi guys, and welcome to my channel, the place for everything investing. If you're new here, don't forget to subscribe. So analysts currently have this as overperform. There's no dividend here because the company doesn't pay a dividend, so there's no information here. So let's now look at their technicals. So the company is down around 70% from its 52-week highs and up 12% from its 52-week low, and the beta is 2.03, so this is well above 1. So 1 would represent the market, so this shows it is twice as volatile as the market. And if I scroll down, you can see the 90-day change and the 180-day change, and also the yearly change for the share price has been on a constant downwards trend. This is a good time to start looking at a stock when it's dropped significantly, to buy at a potential discount depending on the valuation. Before I get into the valuations, I will just take a quick look at the metrics. So these are just a few of the metrics I like to sort of glance at before I do a deeper dive into a company. So first we've got the PE ratio. So ideally I like to see this below 20, but in this case it's 37.53. Having said that, growth stocks do tend to trade at a premium, and I think this is actually the lowest PE the company has ever been in, but the PE has decreased, and that's considering they have actually increased in their fundamentals, especially in terms of their sales. When a PE drops but the company increases in performance, it's usually a good sign it's undervalued. In terms of their revenue, the company has grown over the past 5 years over 50%, which is a huge amount of growth. The profit margin is 14.9%. I'd like to usually see above 20%, but this is still pretty decent. In terms of their current ratio, the company has a ratio of 1.5, which is well above 1. So that shows that the company has a good amount of assets over its liabilities. In terms of its debt to equity, it's well below 1, 0.09, and the long-term debt to equity is 0.05. So to me, these three factors show that the company is in a very good financial position. And in terms of the price to free cash flow, we can see this is just over 20, so ideally this should be about 20 or below, but this is still a really good figure given the current market conditions. I will now value the company using my valuation methods. So I will be looking at the discounted cash flow model and the Benjamin Gray model. In this example, I will not be looking at the dividend discount model because obviously the company doesn't pay out a dividend. And I will also not be looking at the multiples model, but I will explain that later on in the video about why I'm not using that valuation. So now I'm looking at the discounted cash flow model. So in terms of free cash flow, I've used the figure from 2022 as well, although the figures haven't officially been released yet. So if I go onto Yahoo Finance, I'm using the trailing 12 months figure. Here I'm using the trailing 12 months figure here. So as you can see, the previous year ends have been 31st of December, so we are pretty much at that point now. So this figure I believe shouldn't change too much, so I've inputted this figure in here, and that comes to an average growth rate of 121%. So this figure would actually be a lot less if I would have only used these 2 years, because the projection from here to here, the average of that was a lot less than 121. So for my projections, I've assumed a growth rate of 30%, which could possibly be a bit conservative, but if you look at the figure for 2021, it was around that much as well. In the current economic climate, I'm projecting a conservative number for the next 5 years. So if I scroll down, I've inputted these figures that are highlighted in yellow straight from the financials. So that overall comes to a discounted cash flow valuation of 223. If you are interested in this spreadsheet or using your own assumptions, then do click the link in the description so you can access it for yourself and put your own valuations in. So next I'll go to the Benjamin Gray model. So here I've put in a growth rate of 30. I got this figure looking at the growth estimates for the next 5 years. So at the moment they have it at 39.91, but again I just want to be slightly more conservative. But if I did make this 25, then the intrinsic value does drop a lot more. So again, even if I do 20, it'll go even further. Again, you can put in your own assumptions. So now I'm going over to the multiples model. So I did say earlier I wouldn't be using this model, and the reason why I'm not using it is because the other companies within the industry, so General Motors and Ford, historically trade at a low PE multiple, and Tesla, because it's a growing company, its PE multiple is a lot higher. So now I've come back onto the main screen where I've got all the valuations. So if I take this black box out, I can see all the assumptions. So the discounted cash flow is 223, which is what we calculated earlier, and then the Benjamin Graham model is 112.81, and so with the multiples model it comes to 17.83, and that brings the intrinsic value to 117.92. But if I take the multiples model out, the intrinsic value goes considerably higher. So that's up to you if you want to include that model, because it does bring the average down, and I do believe in the current market it's better to be more conservative. So that's the intrinsic value, and because it is a growth company I would apply a higher margin of safety. So I would say around a 20% margin of safety, and then with that I come to a buy price of 143. So for me it's currently a buy with a potential upside of 16%. However, I'm personally staying away from Tesla stock for the moment, because as we mentioned earlier, the beta was around 2.5, which means it's very volatile. So if you just take a look at the chart over the past 5 years, up over 480%. But if you look from February 2020 to the peak, it's gone up 578% in just 2 years. And as quickly as it can go up, it can also go down, as we've seen. So it's already down from its peak 69%. Having said that, the valuation does seem pretty attractive, and historically when stocks are beaten down, it's usually the best time to buy. I will now compare my valuation to other online sources. Yahoo Finance has the average price target as 243. So this is an average of 36 analysts, and Simply Wall Street has it as 160.56. So there's a bit of a difference between the two, but in both cases the company is still undervalued. Please remember, none of this is financial advice. Also, if you want to put in your own assumptions, you can click the link in the description to download the sheet. And if you made it this far, I would really appreciate if you could hit the like button and subscribe to the channel. Also, let me know in the comments below if you want me to cover any other stocks. I will be mainly focusing on dividend stocks for future videos.